In this episode, we're going to be discussing the early career of a medical professional and what their first real bonus should look like. It shouldn't actually be for a holiday, even though they feel like they deserve one, or a new car. It's probably best considered using towards an asset that's going to help appreciate rather than depreciate. So in this episode, we want to discuss what are the key aspects that we can utilize, which is only for medical professionals, that will help them build their asset in the early careers of their medical profession.
Doctors can get LMI waived by most major lenders, sometimes 90%, sometimes even up to 95%, no LMI. And I think that's maybe one of, if not the biggest lever that a medical professional and a doctor has up their sleeve to be able to accumulate and acquire assets. Now, what does that mean? Felix, on a $700,000 purchase, sometimes that's between $10,000-$20,000 savings on just day one.
Yeah, absolutely. So we kind of break back what is actually LMI for all the listeners out there. So LMI means lender's mortgage insurance. And when you're borrowing from a bank more than 80% in terms of a loan, what the banks do, they need some form of insurance to ensure to safeguard themselves against the actual applicant, right? So if most lenders, anything over 80%, there will be a premium that you have to pay once off with the loan application. Now, doctors actually have the benefit of actually borrowing up to 90 and even possibly 95% without paying any insurance at all. Now, when you mentioned on a $700,000 loan or property, that could equate to anywhere between $10,000 to $20,000 straight off the bat, which then can actually contribute towards your deposit. Now, we think about the early career stages of the medical profession, they're probably sitting, in their early mid-30s, you'd say?
Yeah, so where they're at, look, HECS and HelpDebt really is still active. Possibly they've got training loans or they want to reward themselves with the purchase of a new car. But this is also where I find a lifestyle creep starts to come in, right? So as their income does increase, so does the level of their lifestyle and living costs.
Yeah, so being in that early stages, it's okay, yes, we definitely want to reward ourselves for all the hard work and study that we've done, but how do we actually plan to build forward? And this is an advantage where we feel is an opportunity for them to take advantage of, where they can capitalize on borrowing, a borrowing asset class that's going to be more advantageous for them compared to any other career industry, right? And what that means is you can go out and look at an investment property and only need to contribute 5 or 10% deposit towards that acquisition. Now you're going to have an asset that's actually accumulating for you. To give you an example, we've just recently purchased a property, and I feel like in this current landscape, there's a lot of uncertainty in terms of where the market is, what we're seeing in interest rates, but also what the recent budget changes have been. Now, when we kind of look at the economy itself, when it contracts and expands, that's actually quite healthy. But people don't really see that contraction as being something that's healthy. But if you kind of look at the economy and the world, you kind of need that. You can't have something running north for 20 years and consider that healthy, right? Sure. So I was listening to a podcast from the domain editor, Dr. Nicola Powers, and what she mentioned was very, very interesting. So she went back and looked at the data. And if you're looking back into the mid-90s, we've gone through 8 downturns, and this is the 9th. Right. But what was more interesting was that with every downturn came an upturn, an upswing. And that upswing on average nationally lasted for 2.5 years at an average growth rate of 32.3%, whilst the downturn lasted less than 12 months at only 2.8%. So we're kind of in this position now where there is a lot of uncertainty. There is that kind of consensus that we're going through a downturn. But to give you an example, we've just purchased a property for a client in the medical space in the early careers for $720,000, right? Freestanding house. Now, this rents for $750 to $800 per week. I think where the challenge is for a lot of people in the early careers is trying to understand where the opportunities lie. We're very accustomed to what's in our backyard and not looking outside that scope of works. In your early careers, my suggestion would be to focus on investing to build assets, but also cash flow to sustain that your income. We're probably at the early stages, maybe earning 150, 250, you'd say.
Yep.
So for that, you want to kind of make sure the asset is obviously well situated in a growth corridor, established, but also having cash flows to sustain itself as well, because we're not on the highest incomes in terms of where our career could be.
Exactly.
Right. So we kind of want that to sit in the background and do what it needs to do. Sydney, 700,000, 750 for a freestanding house.
Is it even possible?
No, I don't think it is. And that's why we've had to kind of look at other various capital cities that do still have the same metrics and growth factors that will give us that capabilities of actually growing, but sustaining income as well. And that's why we've looked at Perth, but within the inner ring. So if I'm looking at it from where the market is right now, I do still feel there's a really good window of opportunity. There is discussions that we may see one more rate rise before we start to see it kind of plateau out and level before there could be even possibly a decrease in interest rates next year. I mean, some of the banks have actually forecast for 2027 rates could possibly come back. Yep. Right. So what does that mean for buyers? Buyers are very correlated to how the interest rate markets move. But you shouldn't pick the bottom. It's the thing that everyone does, right? They sit on the fence waiting for the market to kind of bottom out. And by the time you actually realize it's bottomed out, it's probably been a month or two, unless you're actively in that 24/7.
Yeah. In my view, there's no better time to buy than today. And I'd say that today, exactly the same time I would have said that in 2020 at the start of COVID, and even 5 years before then in 2015, when a lot of our peers actually started to get their foothold in the property market as well. And if you did that in 2015, look at the prices of your assets today.
Correct.
Right? It's huge. And there was always uncertainty. There's always going to be uncertainty in this world. And I think for those that are able to take advantage of the times, of their position, leverage what they have available to them, they're going to just see that growth multiply